Okay.
Never
Get your
mind.
own personal Dean Tinney video. So, okay, so we've got our debit. And then remember, we have kind of a trick here, but you could also just look at it and say, you know, if these contracts get exercised,
Mhm.
and this is another kind of thing I like to do in terms of mechanics. I like to underneath the leg. I like to kind of not testable, that's called a leg. I like to say, okay, what am I looking at here? Here I'm looking at a choice to buy the stock at the strike price. That's what that bottom leg is. And here I'm looking at an obligation to sell the stock at the strike price. So if these contracts get exercised, if you were a Morgan Stanley customer and I'm your Morgan Stanley broker and I call you and I say, hey, you know that spread we did? The contracts got exercised.
Mhm.
And you should be happy because that means we bought the Apple at 140 and we sold it at 160. That sounds wonderful.
Yeah.
So exercise is a good thing. We have a debit spread. If the contracts are exercised, we're going to be happy campers. Now, the hardest part to get is this concept of the premiums widening or narrowing. And so what we're referring to here is that when we did this spread, the net was 6. This was a net debit of 6. And so as your Morgan Stanley broker, I want to be able to close this out. We got to have more money. So I close it out. If we can close it out for 8, we'll make 2. For 9, we'll make 3. The net difference is what that is. So for example, if Apple, I'll just make up a number, is 159. I just made that up. And I close out at intrinsic value. That's going to be wonderful because this one's going to be 14 and that's going to be 0.
Right.
And so now we've made some money. So that's going to be a wonderful thing. But ultimately, we don't need to get it because debit, exercise, widen goes together all the time. All right. So we got debit, exercise, widen. And this is where we were at last time before we caught ourselves. Now where we were at is what is the max gain and the max loss? What is the max gain and the max loss?
Right. It has to be in between that 15.
Yep, that's exactly right. It's got to be within that. So that's the whole point of a spread, by the way. I'm saying I want to play between 160, 145. I don't want to play anymore.
Uh-huh.
So that's the difference in the strikes. And so of those two numbers that add up to 15, we already have one of those numbers. Right? We have one of those numbers already.
Mhm.
So this is again where you have to be a little careful here because there's a couple ways to proceed. And I always tell people, you go down the memory road, oh my goodness, then you got to start memorizing a bunch of stuff. And so you can either memorize in a debit spread, the maximum gain is the difference in the strikes less than that debit. I think that's a mental mess personally. I like to say there's 15 points to be made or lost.
Uh-huh.
I spent 6, so I can make 9. I just think that's easier, but however you get there. Now, by the way, we don't know what your question is, but you're going to have whatever they want to know. If you stay menu driven, I mean, this would be as a test phraseology. Your customer goes long 1 Apple, February 145, call 11. Short 1 Apple, February 160, call it 5. And then what's coming next. Is it a debit? What's the gain? What's the break even? All that stuff. Now, we've got our gain and loss. So we got to do break even. You got that right last time. So we know the break even has got to be a number somewhere between those two numbers, right?
Mm-hmm.
So in your test, you can eliminate anything offered to you that isn't somewhere between 145 and 160.
Mm-hmm.
And this is why we did the spread, by the way. The reason we did this spread is we lowered our risk from 11 to 6. And by doing so, we lowered the amount of volatility we need to break even. So we're going to take that lower strike. We're going to add that net premium.
Yep.
And we get our break even 151.
Uh-huh.
And then the last thing is, are we bullish? Or are we bearish?
So would you debate that on the debit call spread?
Yeah, well, it's a debit call spread, so it's bullish. But remember, you can always go to the lower strike call. It's the greater premium. The gradient premium is always going to be that lower strike call. Always, always, right?
Gotcha.
So anything they want to know, you've got the answer. All right, let's try another one.
A question like this,
sure.
Quick, and I get the 6 as the max loss for my net premium. That's always going to necessarily be my max loss, correct? This net premium.
The max, well, the max loss, yeah, in a debit, anytime you buy a call, a put, a straddle spread, whatever your net out of pocket, because sometimes you have more than one thing going on. So I'm
Uh-huh.
going to say net out of pocket.
Right.
So whatever you're out of pocket, that's your risk. Now that sounds like a bad thing, but that's actually a wonderful thing, right? I say the worst case is you spend 6 points, both contracts expire and you lose your money.
Right.
So anytime you got a debit spread, money out, that's the worst case. And then remember that's helpful because we know the opposite, right? This is a debit spread. Let's look at a stupid bear. Here comes a stupid bear. Let's see if you can tell me why this guy is not a very smart bear.
Oh, I just watched your videos when you're shorting it and then you're gonna when you're shorting a stock and then you short it when you buy a put.
Yeah, it drives me nuts. I can lose it every. The people are still. All our vendors are out there still telling people like, "Oh, you should write a put on a short stock to generate additional income." That's the most asinine thing I've ever heard of. But there's a lot of ways to be a stupid bear. So we're gonna do a different dumb bear, and here's our next dumb bear, and then we're gonna kind of tell you what we would do instead. So I'm gonna go short. One Apple 140 call at 13. Let's put up, we'll call it a February again. Okay, so that's a basic option strategy. And you seem pretty squared away on basic option strategy. So that's kind of why I'm feeling comfortable that we can roll into something else. But before we do, what's the break even on that?
So call up again. So we'll do 153.
Excellent. Do you want the Apple to be above or below 153?
So we're shorting the call. So you're bearish. You want it to be
perfect. And here's the part which is stupid.
Yep.
If we're wrong, how wrong can we be?
Mm-hmm.
What kind of risk does this have?
Unlimited.
Yeah, right on. And so, what I like to do in terms of process, I like to write below. What am I looking at? I'm looking at an obligation to sell the stock at the strike price. And that's just really not smart. And so what we're going to do, because we're smart bears, is we're offset our obligation to sell with a choice to buy. So what are we about to do? Are we about to create a condor, a butterfly, a flamingo, a spread? What are we about to do?
Are we going to make we're not going to make a straddle, are we?
No, because remember, we're still bearish here. We can do straddles. We'll do straddles in a minute. Choice to buy wouldn't be a straddle. Remember, a straddle would be two choices or two obligations. We're going to go ahead and offset that because we want to collect that money, but we're smart enough to say, you know what, we're not going to collect that money without putting in a ceiling here. Options are all about floors and ceilings. So we're going to go long. Not a put. We're doing spread still. This is still a spread. So we're going to go long.
Okay.
One Apple, February, 150 call at 2. Boom. So, let me fix that. Got stuff going on. You're in New York? I think that's where you said. Yeah, it's pretty cool. I like New York.
Sirens going everywhere. You live right by it.
That's part of living in the big city. I used to have a country place. I spent most of my career in San Francisco, and people in the city, oh, your apartment's so noisy. I go, well, yeah, because I'm in the thick of things. That's good. All right, so here we go again. So last time we screwed up because we didn't really stick to our process, and so what we want to do here is this is a spread. All right, so my question to you is this is a debit or a credit spread? Is this a debit or a credit spread?
So we have more coming in than we have going out.
You nailed it.
It's going to be would this be a credit call spread?
Right on. Let's get our T fired up.
And the credit call spreads are bearish.
Man, nailed it. So you're in pretty good shape, my friend, in terms of your options so far. I mean, I haven't seen any really major holes there. We want to be kind of disciplined in terms of that, and then we want to get that net number. And so what is the net credit here?
So it will be 8.
Yeah. And as we said, you're a very smart bear. Because now you can only make 8. Before you could make 13, but you would take in all kinds of risk.
Mhm.
So very smart bear. I mean, I joke. People always say, "Well, why would people do naked calls?" I say, "Well, because they don't know about credit call spreads or they don't know about covered calls." All right, so we got our credit spread. So I'm your Morgan Stanley broker, and I call you and I say, "Hey, that Apple spread we did? The contract expired. The contract's expired. Are you going to be happy or sad if I call you and say these contracts expired?"
So then so it'll narrow, right?
Yeah, you'll be happy, right?
Yeah. Because
You
you
would
get
say,
the
"Hey, woohoo."
money coming in.
Yeah, by the way, you're kind of a jerk if you say, "Well, Dean, had I done the naked calls, I would have made 13." I go, "Yeah, but you would have been taking all kinds of risks. That would have been smart."
Right.
Hardest part to get. Do we want the difference in the premiums? Right now, the difference when we established that the difference, that's what we're spreading, is the difference was 8. And do we want that number to get larger or smaller?
Smaller.
Right on. So that goes together all the time.
Mhm.
All the action takes place. All the action takes place between the strikes. Options are all about floors and ceilings.
Yeah. Once I get to here, like I'm good up to here. But then when
Okay.
I have to figure out my max gain and loss, that's where
Okay.
I
So remember, so one of the tricks is that's okay. So again, now is there a trick or a way to think about it? So one way I can think about it is I could say, I got my T fired up and I can say, okay, well, let me just think about this for a minute. The worst case is I'm going to buy the stock at 150.
Mhm.
I have a choice to do that. And I'm going to deliver the stock at 140. Right. That's the worst case. So I have a choice to buy at 150 and obligation to sell at 140. So that seems like that would be my worst case because I'm a smart bear. I'm smarter than the average bear. I'm smarter than the average bear.
Gotcha.
Making 8 and losing 2 is a hell of a lot smarter than making 13 and losing everything.
Right.
So if you get good at T, you could do the T there, but the other way we could do it, there's a couple ways to do it. One way we could do it is we say, well, the gain and the loss we know is going to equal the difference in the strikes. And of the difference in the strikes, we collected 8. That leaves 2. Another way we could do it is we could memorize. We could memorize the maximum loss in a credit spread is the difference in the strikes less the net credit.
Mhm.
The difference in the strikes less the net credit. I just think that's a mental mess. But however you get there. Now, remember, if you watch my test taking trips, what I call it, tips, tricks, and
Tips, tricks.
whatever I call it.
Something like that.
If you watch that, remember, I don't ever take on the test any 2 numbers that don't add up to that because that's a 50-50 right there, right? You could just look at the spread and go, there's 10 points. The way I think about it, not testable, but the way I think about it is all the actions take place between here. I mean, that's the whole point of a spread. You're saying I want to play between here and here, and I don't want to play no more.
Yeah, and then
Right.
one of the questions on the test will be,
That'll be one of your tests.
8 max gain or 8 max loss.
Yeah. I told you this is the. I'm kind of menu driven. I believe you should have some kind of a process or menu. So the menu is, can you tell me it's a spread? Can you determine credit or debit? Exercise or expire? Widen or narrow? Max gain, max loss? Break even? Bullish or bearish? And then whatever they want to know, you've got the answer. Now, at some point, you do enough of them. You can kind of just kind of eyeball it at some point, but we want to be disciplined. Look at even leaving myself, right? Every time I leave my process, I can mess up. I'm like, oh, but if you have a process, I just did a tutoring session earlier this morning, and I caught myself because the T wasn't matching up. That's a hint that something's wrong, right? So if you don't have a T, you don't know something's wrong. You're just feeling good and you got a wrong answer. Okay, so break even. What are we gonna do for break even?
So the break even, you're going to take so the lower call, the higher, so you'll add the premium to the 140. So it's 8 to 140, 148.
Yeah, and again, another thing that if you get good at the T, so when what you were saying, I wrote it down November 1st. So you got some time. But the other thing you can do, I mean, it just depends on time. If you can get good at the T and contract specifications, you don't need to memorize anything because again, one of the things you can do here is in your T, you can say, well, the dominant leg is my obligation to sell the stock at 140.
Mhm.
And so what I can do is just say, okay, well, if I sell the stock at 140, ultimately the break even's got to be a number that makes the columns balance,
Yeah.
right? So if I plug in that dominant leg, the dominant leg being the one with greater premium, lower strike always, then I can just shop my answer set because, they offer you 4 potential break evens. You say, well, I need a number that if I plug it in there would make the columns balance. I go, boom, right? That makes the columns balance. I mean, that's what break even is, same dollars out, dollars in. All right. Last thing we got to do, is this a bullish or a bearish spread? Is this a bullish or a bearish spread?
Well, would it be bullish because you're long the 150 call?
Oh,
Okay, you go the dominant one.
larger premium dominates the position. Now you went a little backwards on that, Mike, earlier because you told me exactly the right answer. You said credit call spreads are bearish.
Yeah.
This is a credit call spread, and indeed it is bearish. As I mentioned, this is a smart bear. This is a smart bear. All right, so here you go. So you said you're struggling with this idea of max gain, max loss. So I'm going to put this one up here.
Okay.
And I want you to tell me, I'll spot you the first one. It's a spread.
Okay.
So we're going to short one Apple, February 145 put at 10. And we're going to go long one Apple, February 135 put at 3.
Okay.
So I spotted you at the spread. So is it a credit or a debit spread? Is it a credit?
So it's going to be a credit because we have more coming in.
Right on, right on. So, let's just go ahead and take care of that while we're doing it. Let's net it to get that. And that's going to be money in, and that's going to be money out. And you are indeed correct. That is a 7-point spread. And you said this is more money in than out.
Yep.
Now, if you want, you can just, when you get the credit, either put max gain there or max loss. If that's a debit, we know that that's going to be
the max loss.
Okay. Right. Yeah. So that number comes right out of the gate, so to speak.
Right. That's great. That just
right.
So much by just seeing that.
Yeah, there you go. So yeah, and then remember, you can also get your T fired up if you'd like. All right. So you've told me that this is a spread and this is a credit spread. Yep. Just remind myself that I'm going to put that up there on my. Did you take it last time at the site or did you do it remotely?
Yeah, I have to go to the site. I can't.
I'm with you. The reason I ask is because you do have scratch paper there. So it's not like at home they make you got to do it on your screen. I'm not a kind of guy who likes doing that. All right, so we've identified this as a credit, and so once we get that, we can kind of a little rock and roll because we say credit, we say expire, we say narrow, and we will be right every time. So again, this is the area now, the next area where you've been struggling, but I'm going to give you a hint, but I want you to tell me. But all the action takes place between the floor and the ceiling. I mean, that's the whole reason we're doing this.
Right. So then I would get my 10 of, between the two strikes.
Right on. So whatever those two numbers are.
Yeah, my max loss is 3.
Yeah, whatever those two numbers are, they add up to 10. By the way, another very smart person, because this person's saying, you know what, I just don't want to do those naked puts and hope that the stock is 145 or higher and puts expire and I get to keep the money. That's a wonderful, but just in case I'm wrong and this thing blows up, I'd like to be able to stick it to the next guy. So if somebody sticks us the apple at 145, that's an obligation to buy the stock. Then we turn around and stick it to the next guy because we have a choice to sell. That's still not going to be, what we want to do, but that's better than I'm got to buy Apple 145 and it's like 0. And so making 7 and losing 3 is just better risk reward ratio, which is what spreads are all about. All right. So we got our gain or loss. So now we need our break even.
So we'll take the net premium of 7.
Right on.
And we'll take that to, put down to the.
Nailed it.
And so it's So we go from the higher. We go from the higher. For
Always
puts.
on puts. On puts, always the higher, right? Put, subtract from the higher.
147 minus 7,
Yeah.
and you get 138.
Yeah, and then remember again, muddling is not to be overrated, particularly in options, because if you get good at contract specifications, you get good at tracking money, even if for some reason you forgot that. And then remember, this is bullish, larger premium dominates, which is that short put. This is a bullish, you want it up. But even if you had to muddle for a certain length of time, like you've got 10 here, you got 3 here, the other way you can get the break even, because remember, they're going to offer you 4 choices, is you say, okay, well, my dominant leg is my obligation to buy the stock at 145.
Mhm.
And then I know that the break even's got to be a number that if I plug it in there would make the columns balance, right? So another way to proceed is to plug the dominant leg into your T. And the dominant leg is the one with the greater premium. My dominant leg is my obligation to buy at 145. And then I can shop the answer set and know that the break even is the number that if I plug it in there would make the columns balance.
Right. So each side have to just add up to that.
Yeah, that's what break even is, right? Same dollars out as dollars in. Okay, so pretty good, my friend. So let's try your last multiple option strategy. You're held accountable, and then we'll do some different stuff. Let's do this. You tell me what this is. I'll give you a hint. It's not a spread. It's not a spread. It's not a spread.
All right, we got a long straddle here.
Woohoo! Listen, I think pretty squared away for compared to a lot of people getting tutoring. So good job. So you got to be able to tell me a straddle, and you did so. So the next thing you got to be able to tell me on the test is what is the break even?
So we got to take the 2 premiums of so 6 and 5 to 11,
Yeah.
and then add to the 150 and then subtract to the 150.
Yeah, I mean, here's the market price of Apple. Here's the market price, and what you're straddling is the strike price. I always joke, if I wanted to really teach you options, I'll make you buy one. Once you're out of pocket, you'd figure out pretty quickly how this works.
I'm sure.
Right? So, you gotta get now here we're buying again volatility, but direction's uncertain. Right. Boom, So we're gonna have our upside break even of 161. We're gonna have our downside break even. Listen, I'm not being facetious. I'm terrible at arithmetic.
Yeah, no,
So when they offer me a calculator, I'm gonna say thank you very much. I'm gonna take my calculator, 150 minus 11, and I get our downside break even. Now, again, I told you can kind of muddle around with a T as well. What I mean by that is here's our 6 and our 5 that we're out of pocket. And if we exercise the call, right, we're going to need to have the same number out over there. Right. That's what that looks like in terms of a T. That's why it's the break even, because that's the same dollars out as dollars in, right? That's if I do that. Now, if I do the put, if I stick it to somebody at 150, that's what the other thing I can do. I can either call it away or I can put it. And if I put it to somebody, again, I got to cover my out-of-pocket costs. So if I buy it at 139 and stick it to somebody at 150, that will work. Because I'll make 11 points. I spend 11 points. I break even. So that's what that break even is. The same dollars out as dollars in. All right. So you told me the break evens. You're correct. The next thing we got to do is we got to determine where is it profitable? Where do we want Apple to be in relationship to these 2 break evens?
So we would want it to go up because the
or
premium.
Up or down.
Oh, right. Okay.
Right. We want it to either be above 161 or below 139. Can't be both. We hope it. We hope that we are right that it either goes up or down. Right. What would be the worst price?
If it's, just add.
Yeah, then you're a loser, right? I mean, you lost your 11 points, right? So you need volatility. You need either 11 points up or 11 points down. You don't make money until after that. After that, you start to make some money. So we've identified it as a straddle. We've calculated the break evens. We've determined where it's profitable. The last thing is, when do we use a straddle? When do we use a straddle? So what is my expectation when I buy a straddle on Apple? What am I thinking?
Is it? I kind of get stuck with it. Is it volatility for the
Right on non-directional volatility.
Okay.
You know, I think Apple is going to blow out Christmas, man. I see these new MacBooks and they look wonderful. And I buy a call and I go, hey, well, what if the chip shortage? They can't deliver them and they got to pre-order. I'm not sure. It's either going to be a really good Christmas for Apple or a really bad Christmas for Apple. You know, I don't care, just as long as, you know, by the way, I got a built-in mistake, right? One of these things is not going to work. I can't be right on both of them. So what I'm hoping is I'm going to be right on one leg enough to pay for the other leg. So I think you're pretty squared away on your options based on your performance. How do you feel about your covered calls, your protected puts?
Yeah, we can go, if we can go over one.
Okay. All right. Let me give you one of those.
Sure.
So let's say you buy. Now, remember, when you're doing your test, the minute you hear the word somebody's buying shares, you got to really kind of say, oh, okay, this isn't a stock position. You got to, when you see 100 shares of Apple or 100 shares of XYZ or whatever, you got to then say, well, wait a minute, this is not an option position. This is a stock position, and a stock position dominates. So let's start with this. We have 100 shares of Apple. Now, from that alone, if we were shopping an answer set on the test, we would know that what we got to be able to do is the offset. You know, we just get our T fired up. We haven't done anything yet, but we know that if we have done this, we're going to have an option position that offsets. What I mean by offset is, if we bought the Apple stock, we're interested in being able to sell the Apple stock. And so we know it's going to be one of those two. We're either going to want to bring in some income or we want to get some protection.
Right.
So, you know, this answer set is pretty important on the test. We have two types of contracts, calls and puts. You can either buy them or sell them. Those are our four basic positions. And once we see that I'm long the stock, I can get rid of that one. I can get rid of that one. So I say, hey, what do you want to do on your Apple? Do you want to generate some additional income? I say, Mike, somebody will pay you hundreds of dollars in advance to agree to sell high Apple you just bought low. If you'll agree to sell the stock that you just bought at 148, somebody will give you hundreds of dollars to do so. You say, wow, that's not pretty wonderful. P.S. This is not a naked call, because if you decide to do this, Mike, test question to generate additional income, you have the stock. That's an entirely different proposition. Or I say, Mike, maybe we want to do some construction. Maybe we want to put in a floor. Maybe we'd sleep a little better if we had a choice to sell the Apple stock we just bought at 148. You know, maybe we want to consider a way to participate in a big price increase, but not a decline. So what do you want to do? You want to generate some income, or do you want to get some protection?
So let's short the call and get.
Okay, then remember, that's going to be called a covered call. And so be careful when we're doing this call transaction here, because remember, we can only do one contract. So sometimes we call this a buy right instead of a covered call. This one you got to know by name, right? You got to be able to tell me on the test that it's a covered call or a buy right. So identification's testable. So we're going to buy one. Now be careful. You know, if we write two, there's no such thing as being partially naked. I mean, we're either covered or we're not, right? So we're going to buy one Apple, or sell, excuse me, right? One Apple. Now we got to decide, Mike, how long are we willing to sell this for? The longer we're willing to sell this for, the more money we'll get, because longer term option contracts always have greater premiums. And so, you know, we say, well, it's all about bringing in the Benjamins, right? So maybe we decide we're going to go out to, I don't know, June.
Okay.
This is really important. The disadvantage of this strategy is we're about to put in a ceiling. We're about to cap our gain.
Right.
And so the more bullish we are, the higher the strike we're going to write. The less bullish we are, the lower the strike we're going to write. So maybe we decide that we're willing to sell the Apple at 155. Now that's pretty cool, by the way, because we bought at 148. So yeah, it's kind of cool to be, say you'll give me some money to sell high stock I just bought low. And we can use that to lower our out-of-pocket costs. That's bueno, right? So we're going to lower our out-of-pocket costs. Now, this is the one time and the one time only. This is the one time and the one time only that it is not call up to get the break even.
Opposite. I didn't, even before my my test and stuff using like SEC and stuff, before I came across your stuff, I didn't even really know that that it was opposite for cat for
Yeah.
the
Yeah,
stock.
I try and stress it because I don't know if it makes people feel better, but that's how most people get confused. I'm not really worried when somebody's confused in a way. I've seen them. I get confused. I get worried when somebody's confused in some way. I've never seen people get confused, but it's a very common thing. And remember, what people get jammed up about a lot is I can't tell you how many people don't. And then what happens is they're all focused on this, and they're telling me the break even is 164. That's going to be offered to them. It's incorrect because the stock dominates. So, there's a couple ways to go about this break even. I told you one thing you can do. If you get good at the T, you can just shop the answer set. And you ultimately know that break even has got to be a number that makes the columns balance, right?
Yeah.
So I say, well, 148 is what I'm paying out. And, what I'm bringing in is 9. And so I'm going to be net out of pocket. 148 minus 9 is 139.
Yeah.
And that's my break even. It's the stock cost plus, this is the only time it's a plus the premium. So it's going to be, in this example, 148, stock cost, less premium. Let me fix that. Less premium. So 148 minus 9, and we get our break even of 139. By the way, you could plug that in and say, okay, yeah, that makes a balance. That's what that.
So you can go either way, and that's essentially what they would ask me on the test. They'd give me this, and they'd
Oh
say,
yeah, absolutely. Let's be clear. So
test.
absolutely. Test question number 1. Test question. By the way, I did tell you, even if it isn't testable, I just told you it is. But even if it isn't, if you can't identify, you don't know what to do. And so even if it wasn't a test question, I just told you it is. You got to be able to kind of identify this thing. But even if it wasn't, if you can't identify it, you don't know what to do. And you got to be able to tell me on the test that this is a covered call or a buy right. You got to know why we did it to generate additional income. You've got to be able to give me the break even we just determined. So let's make a note of what our break even is 139. Okay. So then the other thing we got to be able to do is we got to know max loss, max gain. I'll give you your choice. You can tell me either one, whatever you want to do, either the max gain or max loss.
So would you do, if we do the max gain, you would just take the 155, and you would basically, if that was like exercise, put that in there, and then
Perfect. You nailed it. That's exactly right. Very testable. You do not participate past the strike price. You do not participate past the strike price. And so then you can simply net the columns, and that's going to be your max gain. Now, another way, and I think this is a challenge, and I told you that's kind of the challenge too, because everybody has options different. The other way you can think of this is your net out of pocket 139.
Mm-hmm.
And you're going to have to deliver this stock at 155. And that's another way you could get the max gain.
Okay. By just using the break even as what
what your net out of pocket. Your net out of pocket 139. Right. Now, on a very low probability, but I could also ask you, for example, I've seen some, more often the vendor questions about, what's the margin call, and you can use this 9 points to, lower your, so, if this is the margin, I say you need to give me half of this, but you already got 9 in there. So you can use that for your margin call too. Right. And then the other thing that sometimes shows up is this is the only time I'm going to let you do an opening sale without a margin account. An opening sale is what we use to establish a short position. And you're never going to be allowed to do an opening sale on an option without a margin account unless it's a covered call. So you're going to be allowed to do this in your Morgan Stanley cash account.
Gotcha.
If you did any other kind of a transaction, maybe not. All right. So good job on that one. Like I say, it sounds like you're in pretty good shape on the options.
Thanks.
Let's now do the protective version of this, right? So the stock always dominates. So we go long 100 shares of Apple. At 148, that's what Apple's at today. And let's just talk about that before we do anything. If that's all you did today was buy 100 shares of Apple, that'd be 14.8, right? $148 a share, and it could go to zero and you'd have unlimited gain.
Mhm.
And so you say, Dean, I think I'd feel a lot better if I also had a choice to sell. I had a choice to sell the stock at a set price at any time between now and some future date. If you had a choice to sell the stock at the strike price. So what kind of contract is that gives you a choice to sell the stock?
So would that be buying a put?
Right on, right? So remember we said in this answer set, now we're going to be looking at that one.
Yeah.
By the way, we remember we got a 50-50 because we're always interested in the offset. What I mean by that is if we've already bought the Apple stock, at 148, what we're interested in being able to do is offset that.
Mhm.
All right, so here we go. Let's go get ourselves a contract here. You nailed it. You said, Dean, if I want protection, I'm going to buy a put. And that's exactly right.
Protects your downside, right? And
That's exactly what you're doing. You're putting in, I think of options, floors, and ceilings. You're putting in a floor here.
Okay.
So how many contracts do you need to effectively hedge 100 shares?
Yeah, just one.
Yeah, just one. Exactly right. So we're going to buy one Apple. Now you got to decide how long you want the protection in place, right? Because the longer you want the protection in place, the more you're going to have to pay.
Mhm.
Longer term option contracts always have greater premiums. So, we were just talking about Christmas, but you say, well, Dean, they got the fourth quarters coming up and they got to report their earnings within 90 days of year end. So, maybe we go out to March with this protection. Very important. Now we got to decide at what price do we want to be able to sell. A price to sell at a higher price will give us greater protection, but will also cost us more money. Higher strike put contracts always have greater premiums. So, a choice to sell at 145 gives us greater protection than 140, but it's also going to cost us more money. So maybe we go out to get the 145s. And this protection is going to cost money. I think of this as kind of like term insurance on the stock position. So now you paid 148 for the stock and you paid 6 points for the protection. And this is the one time and the one time only. This is the one time and the one time only that you have a put and you were not subtracting.
Yep.
And the reason you're not subtracting is because this is not an option position. This is a stock position. And so our break even is 154. It's one time and the one time only that we have a stock position, right? Whenever you have a stock, when you're doing question, you see that, you got to say, whoa, this is not an option position. This is a stock position. I love what you said, Mike. It looks like it hit with you, the opposite, right? You got to do the opposite of what you would be doing if this was, if you just look at that, you're going to be all messed up.
Yeah. And at first I was. Yeah. I didn't even know. So this.
Well, listening to, don't beat yourself. I 69, just finding a couple points is all you need to do.
Yeah.
So
funny
I
there.
mean,
I look back and there were 3 questions that I even know that I like.
Yeah.
I was like, oh, there were probably about 5 or 6.
Yeah. Well, then the other thing I always tell people too, and you're in this next attempt on the first, be confident in yourself and be confident in your answers.
Yeah.
Because, I always tell people when they get a score like that, did you change answers? Oh, please stop, man. Don't do that next time. Right? So All right. Now here's why we do this. This thing is pretty cool. We don't have to sell the stock we don't want to. But let's say that Apple announces that they don't have enough chips to sell anything during the Christmas season. None. They can't sell nothing. It's all stuck on a ship in China. They're going to have nothing, and they can take pre-orders, and the stock tanks. And in March, Apple is $90 a share. Are you going to sell it at 90, or are you going to stick it to somebody at 145?
Yeah, stick it to somebody at 145.
Yeah, that's not bad. I mean, it's bad. I mean, you lost money.
But you're,
Yeah, I mean, you're not buying the insurance because you plan on crashing.
Yeah.
But if you do, by the way, and that's going to be our max loss. Our max loss is the break even to the strike price, because that's when our insurance kind of kicks in.
Mhm.
And then our max gain is unlimited, because we don't have to sell if we don't want to. And then I told you the reason we do this, and that's testable too in terms of suitability. We do this to participate in a big price increase, but not a big price decline.
So it would be unlimited still, even though you're paying for that premium of 600.
Yeah, sometimes people get hung up on that. Unlimited less 6 is still unlimited. Yes. So
Yeah.
what we're saying is there's no ceiling here, right?
Gotcha. Yeah, it
No
could just,
ceiling.
Apple could go
Yeah.
to.
I've had, I'm not a practitioner anymore, but I've had people, I'm saying, really? I mean, they have, when a doctor guy once was bitching that the put expired, he didn't need it. I said, doctor, you're missing the point. I mean, so you call me in March and Apple's 200 because they had a blowout Christmas, they sold all kinds of crap. And you say, Dean, why it's 200. I go, yeah, Mike, I mean, that's wonderful. It's a 200. And he said, well, but we, wasted 6 points. So, we made 6 points less than we would have. I said, well, yeah, but Mike, the hedge isn't about what if we're right. The hedge is about what if we're wrong, and hey, Mike, I think we should buy another one. If we're here at 200, let's do it again. Let's do it again.
I like your analogy of the hedge of like your dog, you said.
Yeah.
And
Yogi. Hey, Facebook just I've tried not to get too, I just started doing social media this year, but Facebook just sent me a picture of that goofball, my dog Yogi, and I had another one, Cooper, and I miss him. Anyways, Facebook reminds you about, I said that I put on Facebook as I miss my goof. My dog was such a goofball. I've had smart dogs and I've had dumb dogs, and Cooper's kind of a dumb dog. But I'll tell you, the Rottweiler, he gets it. People, you get in his space, he's going to say, hey, what are you doing? All right. So I think you're pretty squared away. So you had taxes and you had municipals.
Yeah.
Do you want to do anything more on options here, or you want to move on to your taxes?
We can, yeah.
Okay. So on taxes,
just to interrupt you too, before anything too, maybe if there's any other big things that you think I should be aware of.
Sure. Well, let me tell you too. I think one of the things that I always try and tell people on tutoring is, where do I think they are based on spending some time with them in tutoring, and I think you should feel pretty comfortable about yourself.
Mhm.
I mean, in terms of, just a little wobbly on the difference in the strikes. Who cares? I mean, that's okay. I mean, you're proficient enough. You're more proficient. Well, I don't know, but benchmarking against other people who are confused about options.
I get it. No,
that's a, I don't know what that means, but
that was
okay.
me a month ago, so it doesn't matter.
Okay, so again, a lot of different ways to think about things. A lot of ways to think about. So on your tax return, you have you working for money, your unearned income. That's you working for Morgan Stanley. And to Mike, to be honest with you, on Series 7, we don't really care about people's paycheck income. I'm just hoping that you have some money left over so I can help you invest.
Mm-hmm.
What we care about is your investments, your money working for you. It drives me nuts. So, Mike, I'm not used to having haters, but I now have haters on social media.
People are always.
Oh yeah, and so the guy was accusing me of scamming and defrauding people like you for $200 an hour, and I was thinking, how am I going to respond to him? And the way I responded to him was, I said, listen, I've been pretty blessed in the securities industry. I have enough money working for me that I don't need to work for the money. So the idea that Dean is going to be committing fraud for $200 an hour, 1 hour at a time, is just ridiculous. It's absurd. I mean, so, Anyway, so this is your money working for you, and we do care about that. So
Uh-huh.
there's all kinds of things in this basket called portfolio. Now, before we start talking about some of these things in the basket called your portfolio, at the end of the year, we're going to net your gains and losses. So you have positions, right, that you might decide to close out. So you don't owe taxes on watching stocks go up. There's no taxable event of watching stocks go down. But, if you at the end of the year close out positions, do closing sales or closing purchases, you're probably going to have some losses and you're probably going to have some gains. And so let's say, for example, when we're all done for the year, you made in your investments, you made $17,000. These are closed out securities positions, and you lost $25,000. So this has not been a good year for you, right? Because you got a loss. And so now what you have overall is an $8,000 loss. Now, let's say at Morgan Stanley, you made 90 grand. What you'd like to do is say, no, I made 81. Because I lost 9 grand or 8 grand, excuse me, 82. I made 82 because I lost 8 grand in my portfolio. And the IRS says, no. The IRS says you can, Mike, reduce your paycheck income, but only by how much are we going to be able to adjust
By that 8,000.
No, only 3. So test question, only 3. So all we're going to be able to do is take 3 over here. And we get to say you made $87,000. PS, that means we used up 3 there. And so you have 5,000 that we can carry forward to next year. Right. We can always bet that. I wish I lived in Rupert Murdoch's world. Unless I've been fortunate enough to know some billionaires, and some of them are not very happy. But anyways, Rupert lost $100 million in a stock fraud called Theranos. And he said, that's okay. I could use the loss of my 100 million in my portfolio.
Yeah.
But man, I wish I lived in his world. What he's saying is that this basket is so big for him that within that basket, he can take $100 million loss and he's still going to make $300-400 million. I'm like, well, that's not my world. That's not my world. All right. So let's get rid of this. So now the other thing that you have going on in your investments is income, right? You got income, and the income you're going to have coming into your portfolio is going to come from what kind of investments are going to be bringing in some income.
So like bonds bringing income.
Right on. Okay. So let's just start with that. So we got some bonds. What kind of bonds are they?
Like corporate bonds.
If they're corporate bonds, remember, they're going to be taxable. So let's just put that there. Yeah, so you're going to have some corporates, and whatever that brings in, you're going to owe taxes.
Right.
The more blessed you are, the higher your tax rate.
Mm-hmm.
So, you're working at Morgan Stanley. Good news, Morgan Stanley, if it works, Mike, you're going to be rich. Maybe not right now.
Yeah.
Plenty of people at Morgan Stanley walking around. I joke they don't need to be there if they don't want to. So maybe you'll join them there. But anyways, let's back to this. Let's say you're in a 38% tax bracket. I just made that up. And so that means any interest you're receiving on those corporate bonds is going to be taxed at 38%. So let's just say it's I'll just make it up, an 8% bond, and that's going to be $80 and annual income, and you're going to have to get back 38% of that. I joke, taxes are the price you pay for civilization. Right. Oh, and Mike, you live in a New York City.
Don't even
you got a city income tax
too. Get me started. It was funny. You mentioned it in one of your videos. You mentioned like the New York City tax, and I was like, oh shit.
There's a legendary. I don't know what I forget what I say in the video sometimes, but maybe you heard this story. But Julian Robinson is a major hedge fund guy, and he was the largest taxpayer to New York State in New York City in a particular year. And he didn't really think he should have to pay it because he doesn't really live in New York, but he didn't feel like fighting it. So he just told to his team, he said, listen, I'm not paying the New York City and state income tax next year. So I want you to track me and make sure I don't go over the number of days in New York that's going to trigger me owing state income tax.
Right.
And so he said, don't get clever. If I just fly over New York, count it as a day, because I don't want to be. Anyways, the next year, New York State and city missed him. They said, what the hell? What happened to you, Julian? So they called Julian and they put him on the stand. They're trying to get the money because they had a receipt from his wife that showed she was in New York City.
Wow.
And so I love this. They thought they had him and he was going to have to pay the taxes. They asked his wife. He said, well, they said to his wife, well, if you were here in New York, that means he was here. She goes, no, it's the opposite. One of our things that makes our marriage work is we agree we're never going to be in New York City on the same day because it just causes us problems.
Yeah.
So when I'm in New York City, he's got to stay out. And when I'm here, he's going to stay out. So actually that proves he wasn't here. I go, he didn't have to pay. So, well, you guys are losing a lot of people to Florida, right? Okay. So what else do you have in your portfolio besides your corporate bonds?
Then you have your in your portfolio. Okay, so like you can have like your your equities. You can have your
So you got stocks. Now the stocks, we're talking about the income component. So maybe some of your stocks you're just watching them go up or down. That's not taxable unless you at the end of the year decide to sell them.
Yep.
By the way, if you just sell them to take a loss, the IRS is going to say, Mike, well, what do you mean you sold it, you took a loss, but then you bought it right back. So even if those stocks you sell them to take that loss on this part of your tax return, how long do you have to wait to reestablish that as a new position? 30 days.
30 days. Okay.
So if you take any of those losses, when you're talking about netting up those gains and losses, any of those stocks you sold, my friend, remember you end up with a $25,000 loss.
Okay.
And if any of those stocks you buy them back within 30 days, you're going to lose that portion of the loss. So you got to wait 30 days.
Where would the wash sale come in?
That's exactly what this is called.
Disallowed. Yeah. They disallowed.
That's right. Wash sale, to avoid the wash sale, because what they think you're doing is just washing this loss.
Yeah.
And they're right, by the way. So they're just saying, well, listen, if you're going to do that, then you got to wait 30 days to reestablish it. It happens, right? I'm looking at my tax return. I go, yeah, what was I thinking? And I still think it's a great stock. It just hasn't worked out timing wise. So I take the loss. I just have to realize I have to wait 30 days, get on the other side, and I can buy it again and try it better for next year. Right.
Right. Yeah.
Okay. So you got some stocks, but you do have stocks that do pay dividends, right? I mean, not you personally, but in terms of the test, right? These are customers and they may have stocks that pay dividends.
Right.
And so if they're paying dividends, the stock is paying a cash dividend. That's important because remember, stock dividends and stock splits are not taxable. Right. So we're talking about a cash dividend. Cash dividends are taxable. And how are cash dividends going to be taxed?
As ordinary income.
Yeah. Be careful. Be careful. You're correct. But we do have qualified dividends.
Oh, right. Yeah.
Yeah. If you own the stock, Mike, like 60, 90 days before the payable, the record date, you might get a lower rate perhaps. And then the other thing, remember, is a dividend of one corporation paid to another is 50% tax excludable.
Yeah, I come across those ones.
Okay, so we got cash dividends, and that could come from your common stocks. That can come from your preferred stocks. What else might you have? So far we got corporate bonds. We got some stocks. What else? What other kind of investments you might have that have tax consequences? Or I could say don't have tax consequences.
I was going to say like let's say you have like a GNMA or something like that.
Yeah, GNMA is very testable. GNMAs, they're guaranteed high probability questions, full faith and credit of the United States government, pays interest and principal monthly. You nailed it, and it's fully taxable. So if you got GNMAs in your portfolio, fully taxable. So that is definitely high risk, high probability. What else could you have in your portfolio?
Let's say like CMOs, maybe like.
Yeah, CMOs, they're fully taxable too. And we are talking about taxes. The CMO questions are, can you tell me, which has more predictability? PACs or tax. The plan amortization classes, remember?
Yeah, it's like
the early cash flows. Yeah. So, okay. Yeah. What else? I'm looking for, we're missing a major thing that you might have, particularly if you're pretty blessed.
I'm drawing a blank. Oh, municipals.
Yeah.
Yeah.
That's a guaranteed test question, right?
Yep.
It's guaranteed that on the exam, they're going to tell you somebody's tax bracket.
Yep.
So you can rest assured, Mike, on a question I say, Mike is in a 38% tax bracket. You know what is coming next. I'm either, Mike, going to give you a taxable yield and want you to tell me tax-free equivalent, or I'm going to give you a muni yield and I want you to tell me the taxable equivalent. So we're in this big area. Let me just get us a bigger basket here.
That's crazy. I got a question on my last test for both of them.
Well, that's possible.
Yeah, I got both.
That's possible. I mean, that's good debrief. I don't doubt it. So let's just talk about that. So you're in a 38% tax bracket, and I'm either going to give you, you said you got both. I don't doubt you at all. I mean, that's,
yeah, because I didn't know what to do for one. I knew the formula of, you're multiplying 100 minus.
That's right. So that's the key point.
I didn't know which one, but
well, here we go. So let's make sure we got it this time. If I give you the taxable yield, you're going to multiply.
Okay.
And if I give you the tax-free, you're going to divide. So that's key. So, and you said you got both. So we'll start with the taxable version of this, right? So the taxable version of this is I'm going to give you the taxable yield. And what we're going to do is figure out what is the tax-free equivalent. Let me get some more board space here. So we're going to take the taxable yield and we're going to find out. I say, hey, I'm not sure, Mike, this makes sense on this taxable yield because remember, you don't get to take all that money home. You got to get back some of that money. So what I want to do is see after we pay our taxes, what is the tax-free equivalent? Because if we can find a muni bond that pays more than whatever this number is, then maybe that's what we should do. And so we said you're in a 38% tax bracket. We said that's always given on the test. And then we said once they give that to you, you know where it's heading. And it's either going to be taxable, in which case we said we're going to multiply. And so let's say that we're considering buying a 7% corporate bond. And you're in a 38% tax bracket. And so boom. I say, well, listen, you're not keeping 38 of that. The 38 you're giving back. So we got times that by 0.62. And we say in your tax bracket, getting 7 is the equivalent of getting 4.3 in a muni. So if I got a muni that pays 5, we should do the muni. If I got a muni that pays 4, we should do the taxable yield. Right. So now, by the way, not only can they make you do the math, by the way, just warning you that the other thing we can do is after you do the math, ask you, what does it mean? Right. So what this means is that if we can find a muni better than 5, that's the better deal. No, I say 5, but 4 anything above 4.3.
So this would ask me this question in order to determine for me to multiply. They're going to say, find the tax-free equivalent or find the
tax. Yeah, they're going to say, yeah. Or if they want to be really hellacious, they can make you do it on 4 different scenarios and say, here's a corporate bond, here's a muni bond, here's this, and then you got to, do this formula more than once to kind of figure out what's the way to proceed, right? All right, now the other version of it, let's try this. The other version of this is we're going to take the tax-free yield, and that's going to be the one we divide. So again, always given information, the tax bracket. And so 38% tax bracket. And maybe we're considering, Mike, getting you a muni bond paying 3%.
Okay.
So this is a New York State or New York City tax-free bond. And so the way we're going to do this now is we're going to take 100% again, minus your tax bracket. And what we're solving for here again is what is that equivalent of taxable? Because, getting 3, you can't compare apples to oranges. I say, well, listen, it's 3. I say, but, you're not going to get you're going to get actually more than that because you're not going to have to give any of it back. And so you're in a 38% tax bracket. So we're going to take 3%. We're going to divide by 0.62. And we get 4.8. And so that means in your bracket, getting 3 and not paying taxes is the equivalent of getting 4.8. That's the taxable equivalent. So again, if we can find you a corporate bond paying more than that, that's what we should do. If it's not, then we should do this.
Great. So when they say, find me the tax-free equivalent, do the multiplication when they
Yeah,
say
yeah, that's right. That's right.
find the taxable equivalent yield. Find
Yeah.
me through.
Taxable, we multiply, tax-free, we divide, tax-free, we divide. All right, so we're talking about your basket called portfolio. We're still in this area called portfolio. We've talked about, again, some of your gains and losses. We talked about the income you could be receiving. Now, another thing we can do over here in your paycheck is, we're trying to take some of your paycheck and make investments with it, right? So we're hoping that maybe you have some money, Mike. You can you give me $200 a month, or can you give me $100 a month? If I can get somebody to invest fixed dollars invested regularly, what is that called? Fixed dollars invested regularly.
Annuities.
Well, it could be an annuity, but dollar cost averaging.
Dollar cost averaging. Okay.
Dollar cost averaging. So if you can give me like $100 a month, and we can go buy a mutual fund, that'd be wonderful. But before we do that, maybe we should consider whether we can take some money out of this pot and put it into a retirement plan, a 401k, an IRA.
Yeah.
Again, because if we can take down that 90, right? If we can take down that 90, like I say, hey, let's fund an IRA for 6. And now we got you down to 84. Right. So that's another thing we can consider in terms of taxes. And then your point, we would have to know on our taxes what happens on those retirement plans. And so right now we're still in the portfolio. And we talked about the tax consequences of some of the investments you make. And so now you decide not to sell all of your shares. So you've been accumulating shares over several time frames, whether you've been dollar cost averaging in a mutual fund or you've been doing dividend reinvestment programs. And now you decide to sell some of your shares, not all of your shares. So how are we going to decide what taxes you owe then? So let's say you have been investing $100 and $100 every quarter, and let's say when you invested this, you got 20 shares, $5 was the public offering price. And then it was $10 was it, and then $5, and then $10. So you get 10 shares, you get 20 shares, you get 10 shares. And so now you have a total of 60 shares. And those 60 shares, you spend $400 acquiring those shares. And so now you want to sell some of these shares, and you're going to redeem. And let's say now the stock or the mutual fund, whatever it is 11. Do you want to sell the shares you bought at 5? Let's say you're going to sell 10 shares, or you want to sell the shares you bought at 10?
The 5 with FIFO.
That's why we're doing this. No, my friend. If you sell the ones at 5 and now it's 11, you're going to have a $600 gain.
Mm-hmm.
So what you want to do is sell the ones you got the highest cost base on. You want to say to the IRS, I'm selling the ones I bought at 10 for 11. And that way you only owe a tax on the point. Now that is called test point. We're talking taxes. That's called share identification, where you actually tell the IRS, these are the shares I'm selling. You could also do average cost. What we mean by that is we could take the numbers here, 5, 10, 15. I got 400 shares that I spent $60, got 60 shares. So 400, I'm just taking my average cost here, 400, and I got 60 shares. And so my average cost is 400 divided by 60, 666. I could do that if I want. That's called average cost.
Gotcha.
But if I don't, your point, if I can't do that, if I can't do that, then the IRS is going to impose on me FIFO. And that's what the IRS wants you to do. Because IRS says first shares you bought are the first shares you're selling. Gotcha. So that's what they're going to impose on me if I don't do the other two.
Right. So LIFO is going to be more beneficial for the holder.
Yeah. Now there's an exception to that. So you brought up a good point. We had this variable annuity. You've maxed out all your other, investment plans. And you said, Dean, I still have a bunch of money. I usually use a high income producing professional athlete You know, Naomi Osaka. Naomi is what, 25 years old. She's making $5 million. I say, hey, listen, give me $1 million after tax, Naomi, and I'm going to buy you a variable annuity. So that's $1 million, and Naomi has paid taxes on.
Mhm.
And now Naomi's she's 24. So what is that, 50, whatever 59 and a half is. And let's say now this thing has grown to 10 million.
35 something. Yeah.
35 years. Yeah. She better not hire me as her broker because I'll be long gone. All right. So Naomi calls me and she says, hey, Dean, I'm 59 and a half and I want to do a random withdrawal. I don't want all of my money out of this thing. I just want part of it. She says, send me the $1 million I've already paid taxes on. Send me the $1 million I already paid taxes on. And I say, Naomi, the IRS says LIFO. Last monies into this thing are the first monies coming out.
Uh-huh.
So that's where we use LIFO is in the variable annuity. Right? That variable annuity, she's going to, most of these questions are based on what yields the most to the U.S. Treasury. What yields the most to the U.S. Treasury, right? So LIFO is going to do that. All right, so we're still, we have another basket we haven't discussed. And the last basket you have is partnerships, AKA direct participation programs. Now, unfortunately, in this basket, nothing gets moved from anywhere. Whatever happens in your partnerships stays in your partnerships. You can only offset passive income with passive losses. This becomes a suitability question because what I'm trying to do is match this up.
Mm-hmm.
So this is one they love. They say your customer has a large amount of passive income. So that means, Mike, he's got all these partnerships that are giving cash distributions. These are called your K1s.
Okay.
And you say, Dean, man, I'm a limited partner. I got these partnerships and I've been doing pretty good, man. I got to tell you, I get all these distributions, I say, oh, that's wonderful. Yeah, so I call you, say, hey, Mike, you were telling me you got all this passive income. What you might want to do is maybe we want to be a little aggressive and maybe take a flyer on one of these partnerships. Because if you do lose money, I hope we don't lose money. But if we do, at least you can use those passive activity losses against your passive income.
Mm-hmm.
And so you say, well, Dean, that sounds like, yeah, why not? Let's do it. And so you say, so let me see to get this right. We're going to be aggressive. Test question. What is the most aggressive partnership we have that might be careful? I'm not saying let's try to lose money because you get in trouble for that, right?
Yeah.
I'm saying let's, be aggressive. So what direct participation program that we have that is most likely to throw off passive losses?
Well, a REIT doesn't pay the losses.
Yeah, that's right. That doesn't pass through. Good point.
The oil, like the exploratory, right?
There you go. Very much a test question. I can't imagine any draw in which you don't get asked about this exploratory.
Like wildcatting and
yeah, wow, that's exactly. Wildcats go places other cats don't go. Right on, right on. Okay, so let's see. I think that's a pretty good overview of taxation. You have on your thing municipals and you have accounts. Municipals, I have always recommended that, one thing you might want to do is fold a sheet of paper in half. And on one side, write all the terms associated with GOs.
Yeah.
And on the other, all the terms associated with revenues. Because a big part of your exam is distinguishing in this area between GOs and revenues. So vote or approval, which one does that go to?
Goes.
Right on. No voter approval.
Revenues.
Right. How about overlapping debt?
That goes for the GOs, right?
Right on, right on. So I think you're pretty good shape. Overlapping debt. How about feasibility study?
That's for the revenues.
Right on. How about debt service coverage ratio?
That's gonna be on the Go bonds?
Nope, that's the revenue.
You, okay.
Yeah, that's called the
Oh,
flow of funds.
it's the debt that they're basically using for like the operating and
There you
management.
go. Right. And that's very testable.
Okay,
In the flow of funds, which fund has priority? We always assume a net revenue pledge.
right, and that's the operating and
Yeah, good job. Exactly.
okay.
Okay, let's see. Competitive facilities.
That's the like the revenues. So you'd have
Right on, right on.
a
Um,
nursing home next to a nursing home or something.
yeah, yeah. How about ad valorem taxes?
Property tax for the Go bonds.
Okay, I'm gonna be kind of a jerk here. How about special taxes?
Oh, like that would be like for cigarettes and stuff. Probably revenue.
Yeah, good job, good job. Yeah, I think you're pretty squared away. Okay, let's see. Moral obligation. What does that? What category does that go in?
So is that? I obviously know it's the government. They will help pay for certain things. Would that be the goes?
No, moral obligation goes over here.
Okay.
And this is where the state may or may not pay you back. So, the state says New York, a lot of people don't know this about New York, but there's a lot of parts of New York that is not New York City. There's a lot of very rural areas of New York. And so maybe there's a rural hospital in upstate New York, perhaps, and they go to the state of New York legislature and say, hey, can we issue these bonds, hospital revenue district bonds for our rural hospital? And the state of New York's legislature says yes. And maybe this rural hospital, because a lot of people don't like to go to rural hospitals, like the big cities with big city doctors, and the bonds default. Then the state legislature takes a vote and they say, all in favor of paying back the hospital revenue district bondholders say aye, all opposed nay. You may or may not get paid back. That whole process is called legislative apportionment. And again, that goes with a moral obligation. That goes over here. How about a double barrel bond?
Those are goes that are backed by the.
Listen, my friend, you should feel very good about where you're at. Very good about where you're at.
Yeah, there's just when there's some sections that I just come across that I.
Okay, so let's talk about some other things. The city wants to underwrite a bond, and it would behoove the city or county or state to hire a municipal financial advisor.
Mhm.
That's Morgan Stanley's public finance. So at Morgan Stanley, we have corporate finance, men and women who raise money for corporations, and we have Morgan Stanley public finance. Those are men and women who help cities, counties, and cities raise money. So they're going to hire a municipal financial advisor who will advise them on the best way to proceed. And it's either going to be a negotiated deal or it's going to be a competitive deal. And so Morgan Stanley says to the city, our recommendation to you, city, as your municipal financial advisor, is you put this out to bid and see who can provide you the financing with the lowest net interest cost. Or Morgan Stanley says, listen, I have a lot of broker dealers I know who underwrite bonds. And why don't we call in my guys I know at Goldman and see what they'll do for us? We'll negotiate with them. That's another way to proceed. The city says, well, Morgan Stanley, you guys have been so good to us. How about you just underwrite the bonds? Can a broker dealer switch their advisory role in a municipal underwriting and switch roles and now start underwriting the bonds?
No, I don't think so. Can they?
Yeah, no.
No.
The MSRB.
Conflict of interest.
Yeah, that's right. The MSRB, the Municipal Securities Rulemaking Board, says you're not allowed to switch roles. So Morgan Stanley says that's wonderful, but no can do. What we can help you is evaluate the bids or help you negotiate, continue to help you up on the contracts. And so I said, but they say, okay, Dean, let's go competitive bid and let's keep you around as our financial advisor to help us manage this process. They say, what's next? I said, well, what's next is we need to have a legal opinion.
Right.
And who's going to do the legal opinion?
I've yet to be able to grasp the legal opinion and how it works.
Well, that's okay. So the legal opinion is going to be done by a bond counsel.
Okay.
And, this is a particular type of attorney. And what he's opining about is three things. By the way, the people aren't going to buy our bonds from us if we don't provide them with a legal opinion.
Mm-hmm.
All right. So the one thing he's going to opine about is that the city has a legislative authority to borrow the money. So if this is a GO that they took a vote and the voters said, let's do it. If it's a revenue bond that, the airport has the authority to go borrow a bunch of money.
Yeah.
The next thing they're going to opine about is that these bonds are federally tax exempt. I mean, because that's the number one thing, our reason why people buy these. And then the last thing they're going to opine about, and this is very testable, is that they're exempt from 33. That there is no prospectus requirement when selling municipal bonds. So very testable. I just told you there's no prospectus requirement for a muni bond. Very testable. So what document do we have that serves the same purpose when selling brand new bonds in the primary market munis?
It's not the official statement, is it?
It is. It is. That is exactly what that's called.
It's like the prospectus for the.
That's exactly what it is. That's right. It serves the same purpose. It's so that you can make an informed decision. Now, this bond counsel is either going to give us a unqualified legal opinion or a qualified legal opinion.
Unqualified being better.
Right. Nailed it. It's exactly right. Okay. So we're underwriting the bonds. We got our bond counsel. Listen, we want to have a good law firm here too. So this is, a name that inspires confidence. You don't want to do this with, Jacoby and Myers. This should be, a law firm that we know can make things stick if it gets nasty. Right. So now we're going to put out our notice of sale. We're going to put out our notice of sale. And where are we going to publish the notice of sale?
The bond buyer?
Right. Get rid of the questioning. Yes. Trust
okay.
yourself. Indeed, the bond buyer, which is a newspaper widely read in the municipal market. And that's attention, investment bankers, we're looking for some help. And so based on that notice of sale, various firms will be forming what we call syndicates.
Yep.
And so various syndicates will be formed to bid on these bonds. So I call you up and I say, hey, Morgan Stanley, UBS here. Did you see the notice of sale? I said, would you like to join my syndicate? And I said, well, Dean, you didn't do your homework. Didn't you see where the financial advisor? I go, oh, my bad. Well, hey, don't forget I love you. I'm joking. I call up Merrill Lynch. I say, hey, Merrill Lynch, why don't you join my syndicate? They're going to say, Dean, what type of syndicate are we considering? What type of syndicate are we doing? Remember the two types of syndicates? Divided or undivided.
Oh, okay.
Also known as Western.
Oh, and Eastern.
Right on. So I call up UBS and I say, would you like to join my syndicate? Let's say we're doing $100 million worth of bonds. So which one you want to do first, divided or undivided, Western or Eastern?
We'll do Western.
Okay, so I say to my friends at UBS, how many bonds do you want to take down? How many bonds do you want to take down? And UBS says, Dean, we will take down $20 million worth of these bonds. In a divided Western syndicate, what goes down stays down. So I call you up and I say, hey, UBS, manager here. As the manager of the syndicate, I'm first among equals. And as the manager of the syndicate, it doesn't matter who sells the bonds. I'm going to get a little piece on every bond sold. That's called my management fee for, running the books and doing the deal, right? So I'm also going to keep some of these bonds for my guys, my own team to do, right? So anyways, UBS says, Dean, we were only able to do 10 million. And I said, we got a mouse in your pocket? There's no we. I said, well, listen, you're going to put that 10 million in your inventory. So You've got 20, 10 you sold to customers, and 10 you're putting in your inventory where your bond desk is going to say attention brokers, blue light special.
Right.
Right. Now, this also could go the other way. It could be a good thing. I call you, and I say, hey, I'm just doing checking in with everybody. How you doing? And you could say, Dean, we said we do 20, we did 20, we're done. I said, well, I have some bonds that didn't get sold. You say, well, see, you wouldn't want to be you. You know, we said 20, we're done. We did 20. Now in the real world, if they could sell more, they'd help us. But on the test, we're doing now. If we're doing undivided, now it's not important that UBS told me 20 million bonds. What's important is that that's 20% of this deal. That's what's now important. So I call you up and I say, how you doing on your 20 million? You said, well, Dean, we said we do 20 million. We did 20 million and we are done. I said, unfortunately, you're not. This is an Eastern syndicate, as you recall. And what I'm doing right now is reallocation. And so you're not done based on selling 20 million. You're on the hook for 20% of this deal. So Mike, I have $10 million worth of bonds I'm reallocating. And so 2 million go to you because that's 20% of the 10 million. At some point we break syndicate. If you're a syndicate member and you tell me that the reason you didn't get it done is because your selling group let you down. Your selling group let you down because what these syndicate members are going to do is build their own selling group. And then I say, well, that sounds like a personal problem, Mike. I mean, selling group members are never liable for unsold securities. So, I guess next time don't put that person in your selling group. So regardless of what kind of syndicate it is, Eastern, Western, doesn't matter. If you're a member of the selling group and this thing blows up, nothing on you, right? Now, what we're trying to capture here is the spread. What we're trying to capture is the spread. So maybe the issuer is going to receive $9.90. I just made it up. So we're selling the bonds at par, these muni bonds, and we're going to sell them to the customer for $1,000. That's what the investors are going to pay. And so what do we call the difference between what the issuer receives and the investors pay?
So is that the selling concession?
No, the selling concession is going to be one of the three components I'm about to talk to you about.
Total takedown?
Nope, that's another component. This here is called the spread.
Right, that's right. And then those
that's right. So we're going to talk about all those components. One component we already talked about was the management fee. And if I'm the manager, it doesn't matter who sells what bond. I say, I'll tell you what, as a syndicate member, I'll let you take bonds down from me for $991.25. So regardless of who sells these bonds, Dean is going to make, as the manager, my management fee. What is my management fee in this deal?
That's the difference between the $991.25 and the $990.
And what is that?
1.25.
I got you, because in the bond game, nobody ever says $1.25.
Right.
You must be new. Players say a bond point is $10. That's the spread, by the way. The spread here is 1 point, and you should definitely know that 1 point is $10. Bond guys are never going to say $10.
Mm-hmm.
Now, if you're UBS, remember UBS is a member of my syndicate, they're taking down bonds at $991.25. They have some choices to make. And one choice is to keep the bonds and sell them all themselves. And if they do, they would make the total takedown. And the total takedown in this example, that's the difference between 991 and par. So what is the total takedown in this deal?
So that would be 8.75. So
7/8.
Oh, 7/8. I'm sorry. Yeah.
That's no, don't be sorry. We'll turn you into a player. Yeah. All right. So, but if you build your own bracket, it's called building your bracket, not testable. But if you build your own bracket, you can sell some more bonds. So, UBS might call Schwab and say, hey, Schwab, I know you guys don't do syndicate stuff, but I bet you have all kinds of Schwab customers who would like some New York City income bonds that, I bet your New York City branch could probably sell a lot of these. Would you, Schwab, like to join as a member of my selling group? I say, yeah, what can we have the bonds for? And UBS says, I can let you have the bonds for $9.95. I can let you have the bonds for $9.95.
Mhm. That's the addition to.
And so Schwab is going to make,
That's their selling fee.
yeah, it's called the selling concession. And let's just review here. Typically, the smallest individual component of a spread is the management fee.
Mhm.
And typically, be careful because there's two ways to ask this. The largest individual component of the spread is the selling concession.
Wow, the other one's
Be careful. Yeah, be careful. But if I say what's the largest component, right? But that's not a single component. That's actually two.
Mhm.
So boy, we always say RTFQ. RTFQ. That means read the full question. If I ask you what is the largest component of the spread, it's the total takedown. But if I ask you what is the largest individual component of the spread, that's the selling concession. So there's potential two answers there. Okay, so I think we got pretty much everything done. I don't know if you meant an accounts, cash accounts, or margin accounts. I know what you meant there, but I would point out to you the one you really want to make sure you get is all the questions you're entitled to on UPMAs.
Yeah.
One minor, one custodian per account. Make sure you know no margin. Make sure you can stipulate the age 25. Don't overdose on margin. If margin was part of your customer accounts, I wouldn't worry too much about that. There's 2-3 questions. Make sure you know documentation, the credit agreement, the hypothecation agreement, loan consent is optional. Know the 25%, know the 30%, know your classical margin equations, which is long. That's the classical margin equation, long. Know your classical equation, short. But that if you tell me you missed the mark because of, margin, I'm going to say, really? What were your other, 30 questions?
Yeah.
I mean, of your agenda, taxes, I think taxes are there. I have a tax lecture that's up on the channel, but of all the things you wanted to talk about today, options and munis are the biggest.
Yeah, for sure.
That's where you're going to make up a lot of ground. So there's actually, I don't know how much of the channel you've had a chance to use.
Basically,
But what's that?
basically every video.
Oh, you've watched everything?
Basically, I just
Wow.
watched.
Well, okay. Because I have 3 munis up there. I put the thumbnails with different bond certificates. So I got, one that has the California tombstone, and there's a San Francisco bond, and then there's a I want to say maybe you knew it, but anyways, there's 3 muni lectures up there. So, and options. Oh my God, I got there's hours and hours and hours of options. So you got but if you watch them all, it's pretty good. Anything else?
Yeah, I would just say for me, I was mentioning earlier is because I've been doing this for so long now, and it's like I'm kind of at a point where it's like, I'll look at index cards, then I'll read notes, then I'll read the book.
Yeah, you might want to consider. Maybe you want to get a supplemental. Did you say you're using Nopman?
So I have Notman, but I primarily used STC. I just got Notman for the more.
Okay, well, my discount code, you're welcome to use it. My discount code is Guru10 at Kaplan. And you can buy the Kaplan Q Bank for like $60.
Yeah.
And I think having additional questions are good because it's hard for your point. I don't want you memorizing questions. So if you need to spend, another $60, I mean, hey, listen, I mean, I could tell you're willing to invest in yourself because you got a tutoring session today. So, that's one idea. And you're going the first. Today is the 21st. I don't want to make any promises, but I'm working on another practice exam. But I would suggest maybe buying a Q Bank.
Okay.
So buy Kaplan, don't buy Past Perfect. Oh God, don't buy Past Perfect. I mean, they're so in the weeds. They're not bad, but I mean, oh my God, they take you down so many rabbit holes. So either buy Kaplan. I'm not a big fan, but a lot of people love Achievable. It's kind of cheap, and you can check them out. They give you like a free trial. If you just want some more questions, Brandon Rith is the guy who's in charge of the content. It's okay, and it's a good price. But I think you can't just buy a Q Bank. I think you got to buy the whole shooting match. And I think it's like 100 something, I think.
I have a ton of questions left for Notman too. They have so many that I haven't even touched. So I'm probably going to stay with that.
Okay. Well, Notman, I think, is using the Kaplan Q Bank, I think.
It is. It's like through. It's for whatever reason when I go through Notman, it
Mhm.
has a Kaplan, like directory or something. So it's
Yeah.
probably
Yeah, it's probably Kaplan. And that if it's, I mean, they're using Kaplan, but I know they supplement it with their own stuff too. But if it's Kaplan, the other thing Kaplan has, and I bring it up on my screen, is they have QID numbers on the questions. And you're welcome to send me a QID. You don't have to cut and paste if that's the case, because I have access to all the Kaplan Q banks. And I can bring it up on a shared screen and see what what you're looking at or what you're thinking about, or just send me an email and I'm more than happy to tell you whether, hey, Mike, I'm glad you sent me this is testable, or Mike, here's the answer, but it's not testable. Just kind of help you, get your bearings about where you need to be. So
yeah. So you think I should just really take more and more questions and maybe
yeah, I think you're pretty good. To be honest with you, I haven't seen any gaping holes in anything, and
uh-huh.
everything on your list. I didn't think you were wobbly to the point where if I was a betting man, somebody, are you betting on Mike to pass? I'd say, yeah, I'm going to bet on the pass. So,
Yeah.
yeah, I do worry. I do worry that we've got 19 more days. So are you expected at Morgan Stanley? Are you just a study guy? I mean, is
Well,
it
yeah.
more?
So right now, I have to finish. Like we finish our studying and stuff, and then when my test is done, we went through all of our trainings and stuff already, which was good for our actual job.
Yeah.
And then pass, I get assigned the financial advisors I'm going to be working with.
Okay.
And from there, I'm good to go.
Yeah,
So
so yeah, I do, I think it's a concern, but I mean, I guess what I would say is that I call it a champagne problem,
yeah,
and not a real problem. A champagne problem is you're where you need to be and you got to wait, but you've done the work. I mean, you could be in a lot worse situation,
of course.
right?
Yeah.
So, so it is what it is. So I'm not too worried about you.
Cool.
You should give yourself permission to take a break, but make sure you keep your rhythm.
Yeah.
What I mean by that is if you really feel like you're just burning out because you're doing that, I mean, that's not productive either. We want you to be well rested. And so, based on your performance today, I would give you, I don't know, Morgan Stanley will give you permission. Don't say Dean said, because they don't give a damn what I say, but you should feel comfortable just relaxing and say, you know what, maybe I'll take a couple days to get some distance from it and then come
Yeah.
back. And sometimes that helps because then your brain is fresh again and you're doing it. So if you need to, I think as your tutor, I would say that I wouldn't have any problem with that.
Well,
But
great.
yeah, again, I'm not your accountability partner, so like I said, I would hate you to make a mistake and tell somebody at Morgan Stanley, "Oh, my tutor said,"
I,
say, "Mike, who's that guy again?" We don't care.
the one thing I run into is like, because I've seen the tests and stuff already, and it's like I wonder, there's so many things that I could be tested on, and it could be in a different verbiage that I'm.
Well, you're welcome. I mean, you're welcome. If you want to book another session, I could bring up a practice final at Kaplan on a shared screen, and we can go through it together, and you can answer it, and I can tell you, if you miss it or not miss it, what you should have got from it or not. I mean, that's available if you want to do something like that. I'd save that because you're going to be, like I say, we're talking about pacing yourself, but a lot of people in tutoring sessions like to do a shared screen final. Um, I don't want to make promises I can't keep because I got to teach a Schwab 7, but I'm almost, tempted. Maybe you check in with me next week. Maybe I can get a practice final 4 done
That'd
because I'm
be
working on that on the channel, and then maybe we can do that together and field test it, and that'll give us something to do. So,
yeah,
but yeah, I don't want to make a promise I can't keep, but that would be another alternative.
yeah. No, that'd be. I mean, again, I've learned so much from you without you even,
Well, I'm glad to hear it. It's been surprising. I'll just tell you the little background. I started the channel, the whole social media campaign. I started in January because I'm a backstage guy. I've never been a social media guy, but when the pandemic hit, I said, you know what? Because I wouldn't let Schwab or anybody record anything because I'm like, why would I let you record my stuff? Because then you don't need me anymore. But when the pandemic hit, I said, well, if everybody's going to go to this model, I said, I need to have an independent relationship with test takers. I can't be dependent on, Mike's at STC and I'm at Kaplan and, I can't do that. So I thought, okay, I got to have a direct connection. And then I wanted to make sure that all my content was proprietary because I didn't want, Kaplan accusing me of, stealing their slides or STC. So I mean, that means a little more work for me because most of the guys are, doing their using somebody else's stuff, I'm not, but I've been really, like I say, comments like yours, and now people are finding me through Google, and we just hit 126,000 views. I mean, I didn't have that much expectation. And then you can answer this too. I haven't revealed my subscriber count, and here's why: because I think people who come into our lives for a reason or season, And so I think that when I look at my competitors' channels, they got like, a count of 5,000, but it's 3,000 people who passed 10 years ago.
Yeah,
And so I'm more interested in engagement than I am, I've been trying to get up to speed on how to, edit videos. I'm not very good. Basically, how what I know to do is hit the record button and record it and then hit the, that's all I know how to do. So I wish I could do other things. I'm getting there. But what I was going to say is that subscriber count, the YouTube, gurus that I try and listen to, they say that the subscriber count can help with what they call the bandwagon effect. But if you're getting members without the bandwagon effect, then that's even better. So I kind of feel like it's even better. And I haven't had anybody who told me they didn't join the channel because they can't see how many subscribers I got. Most of the time, people who tell me that are the haters. Like,
Yeah.
how come you don't tell what your subscriber count is? I'm over 2,000, but I don't want people joining the channel because of the 2,000. I want to, and I think my engagement, I don't, I try and benchmark a little bit. Our engagement on our channel is as good as any other channel out there.
Oh yeah.
And I don't do shorts. I mean, I'm thinking about it, but I'm trying to make it so it's organized. And so, you got your playlist. So you found the test taking tips, tricks, and mnemonics.
Yep.
And so what I'm hoping is when somebody finds that, then they come to the channel, they can figure out what they need next. Because
I think that helped, especially with yours, is that I listen to STC, listen, not in the marks. They speak it like it's it's just the material from a book or the stuff that they know. What I found really helpful is your examples and your real life like breaks in between and your correlation to that, because it's like, okay, I can actually look at it and apply it.
Well, I appreciate it because I tell stories. I mean, some people give me heat. I told you the haters, but they're usually my competitors, and I'm like, I'm not used to being hated. So it's kind of like, and they accuse me of I've had some of these tutors accuse me of telling, stories that aren't true. And I'm like, listen, man, I don't tell any stories that aren't true. I mean, I don't know what to tell you. I don't know how I'm supposed to prove my stories to somebody, and who cares, right? So we keep building channel. We keep building it out. So I'm right now. Do you got to take your 66 next?
No, I'm actually, so they
Oh, you said you got your 63 already, right?
For it. So
okay. So you're done after this.
Got that out of the way. But yeah.
Cool. Okay. Because that's the other thing I'm building out is the other exams. And I just got off the phone. I just did a tutoring session before you with a series 24. And before I put 24 up there, I didn't even think, people said Dean 24. And I go, I don't know how many 24s are out there and how many there are. And I put that up, and I've already had all kinds of 24s. I guess found it on Google, and they've been calling and saying, hey, and I'm like, hey, I'd like to put more stuff up for you on the 24, but to be honest with you, there's more numbers. I can help more people with sevens and SIEs. I mean, I don't mind helping 24s, but to be honest with you, they don't need as much help. So, but it's been surprising.
People who desperately need the 24.
Yeah, and then like I say, it's a lot. Then sometimes people will complain on the channel. I said, well, you get what you pay for it, and you didn't pay anything. So I don't know what you're bitching about, right? I mean, I think people who are getting tutoring have more of a right to bitch because they're paying. So until you pay, my mom calls them moochers. Is that one of the moochers, or is that one of the people that's paying? So
I'll say one thing though, don't worry about the whole social media stuff, the haters.
Yeah. Well, like I say, I'm new to it, but I just crossed on LinkedIn too. I just crossed 1,000. So, like I say, it is what it is. I'm pretty thick skinned. So yeah, your point, I don't take it too seriously because I was in the Marines. So listen, you getting shot at is a lot more stressful. So it's gonna be great fun. I get to meet some new people. The other thing I like, Mike, is what like I told you, without the channel, we wouldn't have met because you'd be at STC or Knopman, I'd be at Kaplan. So it's neat to get to mix it up. And the other thing I told you, like I now can tell people don't get the past perfect because I know what their stuff is because I've had people I've helped. So that's been fun too, to see what else is out there in terms of other people's stuff.
Of course. Well, Dean, thank you so
much.
Again, I don't think I'll ever be able to thank you enough.
Oh yeah, it's my pleasure. Come out to New York. You can buy me an adult beverage. And like I said, if you need me, you know where to find me. And check in with me at least once because I'm going to try and get that final exam 4 done. Like I say, I got a lot going on, but I'm going to try.
Of course. So one last question for you, just so my prep the next day to whatever until my test, just continue to take questions and maybe read the textbook stuff.
Yeah, give yourself permission to go light in terms of what I mean. Like, don't it sounds silly, but it is possible to study too hard.
course.
And, you know, you wouldn't think I'd be telling this to you after you missed the mark the first time, but pace yourself.
Yeah.
So if I were your accountability partner in a way where like I'm your direct report, and I would ask Mike, what is your daily discipline going to be? And what I would be looking is for study blocks. And I would usually, if you're like a full-time studier, I would be looking for 4 study blocks a day,
Okay.
hour and a half. So that would be 6 hours. I wouldn't expect you to be doing 8 hours. And then what I would want you to do is rotate your activity. What I mean by that is you can't do, if you have 4 study blocks, you can't do 6 hours on options.
Yeah.
So what you can do is change the channel intellectually. What I mean by that is intellectually and activity. So if you're going to do your first study block, you're going to read and maybe you're reading about options. Second study block, you maybe do questions on munis. Maybe third study block, watch a video, and just keep rotating that around. And then at some point, this is the thing we talked about with questions. I'm a big believer in doing what I call intellectual inventories by doing practice files. And so if I was your accountability partner, at some point, I'd be saying to you, okay, when am I going to start seeing practice finals? And am I going to see one every other day, one every third day? You know, as you get into the calendar, I think you told me November 1st, right? So I'm just looking at the calendar here.
Yeah.
And if I were your accountability partner, I'd be wanting to see, oh man, the month is flying by.
Yeah.
I'd want to see at least 2 finals from you by next week, you know, maybe one Wednesday. You can do more, but at least, you know, 1 or 2 next week, Wednesday, maybe Friday. Have you done the mastery yet?
Yeah, I've done. They have STC has like the green light exams.
Yeah. Have you done any? What are you scoring on those?
Those a while ago, but before my
Yeah,
first.
well, do take it. So my biggest recommendation to you to right now, this is Thursday, when you're feeling fresh, besides the study blocks and activities, is do a practice file, do an intellectual inventory. Let's get a score and see what that score is. And here's what I tell you about practice file scores. I'm not as familiar with STC scores and how they translate as Kaplan, but immediately past perfect, I think you could get a much lower score. But that being said, I always, if I'm talking backstage to the person who is, you're their human capital, and it's like your draft team and you're coming up from the minors, and they say, hey, what do you think about Mike? If you get over a 70 on a practice final, I'm willing to tell an accountability partner, I'm not worried about Mike.
Okay.
If you get between 60 and 70, it's not Mike, it's just in general. So it's statistics. So, you know, I'll do a cohort like this next week. I'll do a cohort of Schwab. It's going to be like 40 people. And when I'm talking backstage to the accountability partner, I'd say, listen, they all just did their mastery. And we've got 30 people who got over 70. I think there's no worries. We got 8 people between 60 and 70. I think we're going to lose half of them. There's no reason to lose half, but we're going to lose half because they're not going to be resilient. They're going to stop working and they're going to start, you know, watching videos and not doing more practice questions. We're going to lose them. There's no reason for that. Last time they all passed, which I'm so proud of because that just meant they didn't. They kept working. We had 2 people below 60, and I just said that's really tough. It's just really, really tough because that means they don't have enough knowledge base to answer questions. They're just staring at questions and they don't know what they're being asked. I was proud of them. They closed the gap. They missed it. They both got 69s. They came back and got it again. But I mean, just that gap, you know, we'll be teaching, we'll do the class Monday through Wednesday. They take the mastery Thursday, testing Monday. So there's not a lot of, you know, gap there for them to close that. And those 2 people closed the gap. I was very proud of them as well. You know, sometimes people are like, you're so excited and I didn't pass. Like, oh yeah, but you worked hard, you know, participation trophy. So, and you know, they circle back and pass. So that's the same thing for you. So if we can take that practice final and we are in that 70 range, and then, you know, I call it the 747 principle. If you get below 70, it's still CPAC smells up. You're trying to get that plane off the ground. But if you're in the 70 plus range, you just got to stick the landing. Now, I told you, I don't like that we're in the air longer than we should be.
Yeah.
Right? So that's our challenge is to, you know, keep you flying there. Right now, I kind of think you're circling the airport because you're in pretty good shape, right? So, you know, I would prefer we could, you know, can we ask permission for an early landing?
So
yeah, so that's where you need to be. And then, like I say, you get below, not every day is going to be good too. So I've had people who are cruising, and, you know, and then they get a bad practice. I had a guy call me. He goes, what do you think I should do? I said, I think I would take another one right now. Let's get that out of your system.
Mhm.
And he bounced back up again. So every once in a while, you're going to, you know, not every, as you probably know already, you've been at this a while. Not every day is a good Series 7 day. But so, you know, you got to just, you know that too. And that's why I told you where you're at. Are you in the office or are you still working remotely?
Luckily, I'm actually remote because they're like, you know what, just stay home and study. And get
Good,
through it.
good. So that's why I told you, you get even easier for you to take a break.
That's
If
what
you
I
get
like.
in that spot, just take a break. Say, you know what, I need to walk around the block or, get an adult beverage, whatever it is you do, and just, home and then come back to it, right?
That's great. I mean,
Yeah.
again,
Yeah.
thank you.
And then, like I say, if you need me, you know where to find me. And now you owe me a November 1st call, if not sooner, because I'm going to be with you in spirits. And
Sounds
I
good.
want
Of
to know what happens to you so you can get this thing done. So,
course.
um, you
Totally.
know,
100% give you a call. Absolutely.
okay.
And I'll keep in touch, between the weeks, letting you know how
Sure.
it's going, and then we'll touch base about the practice exam.
Yeah. Yeah. Like I say, I'm gonna try and do it because loyal people like you do. I'm very impressed when people tell me they watched everything. I'm like, wow, okay. Warms my heart, but then it makes me think, oh, I better get some new stuff up there. So
I rewatch them too because I pick up something new and I'm like, oh, that's
a lot of people tell me they do. I had a guy today, I was telling people we just crossed 125,000 views, and he said, Dean, I think I'm 1,000 of them. I said, well, that's fine. That's fine. So, all right, my friend, I'll see you when I see you. And I think you should feel really good about your performance in tutoring today.
awesome.
Like I said, I was a betting man. I bet that you're going to slay this dragon the next time. So,
Well, that means a lot coming from you.
okay. All right.
All right, have a good
I'm
one.
going to let you go.